Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
Welcome back, everyone, to the Spend Life Well Show. I'm Certified Kingdom Advisor Mark Trice. Joining us today on the program is author and economist, opinion writer, Jerry Bowyer. Jerry is the author of The Maker versus the Taker, What Jesus Really Said About Social Justice and Economics. And Jerry, thanks for joining us again today. This has been a fascinating first segment. And if we had about a 3-hour show, we could cover everything that's on your mind today. But we got a call that came in during the last segment. There is from Jefferson. Jefferson just has a question about 5-year bonds that are tips. He's just listening in. I think the challenge, Jerry, is that we've got long-term treasuries that are down more than 20% year to date, and people that are used to looking for yield in their bond portfolio are nervous, and they're exploring all sorts of different options that are out there. TIPS, which stand for, that basically are inflation protected type bonds. A lot of people have questions about those since just yesterday we got the CPI data, and surprise, surprise, inflation is still going up.
Yeah, quite high, 8.6% year over year. Down a little bit in the month over month. So if you look at the high frequency data, there's a little bit of complexity to that story. But yeah, we have an elevated inflation period, and a lot of people were in denial about that. And the Fed, back in the spring of 2020, saw deflation and said, well, we can't have deflation, so let's just throw everything but the kitchen sink at it and just vastly increase the money supply. So just like in your personal life, it's the same with the economists. The thing you do to get out of the jam, if you do something to get yourself in a jam, then the thing you do to get yourself out of that jam creates your next jam, right?
Right.
So, I know this is somewhat controversial, so I'm trying not to take sides, but what I would see as excessively broad and long lockdowns in response to the pandemic, created obviously deflation. If you're not allowed to buy things, then the price of them goes down, right? So instead of thinking of that as a real deflation problem, it's not, it's a shutdown problem. So instead they used monetary, practice, monetary policy to go after it, and just pumped money out of the system like crazy. So then when people go back and buy again, what happens? An explosion of prices because of all that money. So we're in an elevated period of inflation, and I don't think it's going away too soon. I'm not saying it's going to stay at almost 9% indefinitely, but I do expect it to be elevated for a fairly long period of time, and that's a concern. And that has moved people towards TIPS, Treasury Inflation Protected Securities, because that is an investment specifically designed to protect you from inflation. And because people have been buying TIPS so much, when you buy a bond, the price of it goes up, which means the yield goes down, right? Because, that's just how the math works. It's numerators and denominators. The yield is negative on TIPS. That's how much in demand they are.
Right.
So people look at that and they say, well, how can I possibly make money on a negative yield, right? Well, but people thought, how can I possibly lose money on bonds which have a positive yield? And the answer is with bonds, you make or lose money two ways. You make money because you get those interest payments, but you can also make money when the price goes up, and that's a capital gain, which means you can lose money when the price goes down. And for something like 30 years, bond prices were almost always going up. And people got to think like, oh, I'll just collect my coupon and nothing bad can happen to me. And now it's the shock of their lives to see capital losses coming through in their bond portfolio. So that's why they're looking towards TIPS.
Well, and Jerry, you were just a young, very young adult when this last bull market in bonds started in the early 80s.
Yes,
and that's coming to an end. We saw
I think so.
on on Friday, the 20-year the 10-year Treasury closed up at 3.15%. We haven't seen
Yes.
those levels in a while.
Yes, and they're still below the historic average for a 10-year, which is about 5%. They're below the natural interest rate. So the Fed still has its thumb on the scale. We still have unjust weights and measures. The Fed has had like their foot on the scale for a long time, and now their hands on the scale, and now their thumbs on the scale, and we say, "Oh, the Fed's tightening." No, the Fed's not tightening. It's just not loosening the way it used to. It's kind of holding steady. So, I mean, for interest rates to come back to the natural rate, prices would have to go down a good deal more. And I don't think that people were psychologically prepared for the idea that they could lose so much money in the bond market, and that's a shame.
So Jefferson, I mean, you're still listening, and the question that you had there is very important. You want to make sure that you're talking to a financial advisor a little further before you make any decisions to invest in tips or anything for that matter. So I encourage you to reach out. You can reach out to us at spendlifewell.com, or if you go to kingdomadvisors.com, you can also look for a certified Kingdom advisor in your area. So take a moment to find someone that'd be happy to talk to you, and we certainly be happy to talk to you during the week.